Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I decided to come on here and do a live and ultimately have a conversation about one of my favorite topics, that is whole life versus index universal life insurance. And you know what? There's a lot to be said on this. I think, unfortunately, I get the reputation of being the guy that just absolutely hates index universal life because I've done a lot of content on, Doug Andrew and kind of the way he does it being wrong. And I've done a video on MPI and Curtis Ray and why that isn't a good thing either. And ultimately, I guess what I want to start off by saying in this video is I have no, overall problem with index universal life as a whole, meaning I think it fits a purpose. It serves a purpose. And there are use cases where index universal life can make sense. My big problem isn't with the product in and of itself. My big problem with the product isn't the product at all. It's the people selling the product as something that it's not, right? And so it's not the product, it's how it's sold, and it's the fact that wholesalers and companies have kind of, I'm going to just use the word even though it's an extreme word, they've kind of bastardized the product. They've turned it into something that it's really not meant to be. And so ultimately, what I want to do in this video is discuss, the overview of index universal life, talk about whole life insurance, talk about the functionality that life insurance should play in your life in general if you're going to utilize it as an asset. I guess that's a good place to start here. So when you look at life insurance, but I guess if you want to think about utilizing life insurance, or if you are somebody who sells life insurance, this is what I really encourage you to think about. Life insurance companies were never designed to be retirement planning companies. They help people manage risk, and there's no doubt about that with what they do with annuities. However, the risk that an insurance company has with an annuity is the complete opposite that it has with life insurance. And so that's a completely different game. That's guaranteeing people income for life versus the risk with a life insurance company with a life insurance product is that you're going to die too soon. So if you buy life insurance and you die soon, that's where the risk for the insurance company is, because if you die, you have this insurance, they have to pay you out. With an annuity, if you get this financial product that's guaranteed to pay you income for life and to pay you a check every single year, the risk to the insurance company is that you live too long. And so it's important to understand that the companies out there that sell both life insurance and annuities, which is most companies that sell life insurance will also sell annuities, they hedge their book of business against each other. And that's one of the ways that they manage their risk, is hedging these things out. Now, at the same time, I really think it's important to understand that life insurance companies, I always say this to people, and it's important to understand, is life insurance companies are the best managers of risk in the world. If you use just a little bit of common sense, then it's really easy to come to the conclusion that life insurance companies wouldn't be around today if they weren't the best managers of risk in the world. I mean, think about it this way. Companies have been around since the early to mid 1840s in the United States. That's before the Civil War. That's before the assassination of Abraham Lincoln. That's before all the world wars. We've had 3 different currencies in this country since whole life insurance was actually created back then. And there's been all these instances and all these different strategies and products and whatever that insurance companies have built that have come and gone, and whole life insurance has stood the test of time. And I think it's interesting that when the economy shifts, when there's opportunity for companies to do different things, they take advantage of it and they create products, but those products come and go. People get hurt in the process. And I think index universal life is going to wind up playing out much to that accord, not because the product in itself, once again, is going to be the problem. It's going to be the way that the product was sold. And I know there are a lot of people out there telling you that you can go minimum death benefit, maximum cash value, fund this thing. But there's a lot of different ways to do that. Fund it up to the DEFRA, TAMR levels, follow the guideline premium test. do all these different things that they say you should do. But the bottom line is, I've seen it, and it's about your expectations. It's not that the policy is going to explode. It's not that it's going to lapse. It's not that you're going to fall into this horrible situation because of an index universal life policy. It could be that you fall into that problem. But my biggest challenge with index universal life as it's sold today is the fact that it's just not going to meet your expectations. So what I mean by that is, if you get an illustration from somebody and you are banking on that, whatever that winds up being as far as how you're funding it and so on and so forth, if you're expecting $50,000 a year of income coming out of this index universal life product, when you hit retirement and you're thinking that tax-free income is going to be there, I think you're going to be seriously let down and disappointed. And so when it comes to your expectation management, that's the most important part here. So if you want to look a little bit more deeply into this, I have a video that I did, and it was a really amazing interview with a guy named Bobby Samuelson. He actually writes a blog. It's called lifeproductreview.com. I did a video with him. You should go check it out. It's awesome. I'll put it in the chat here. I actually just put it in there for you. It's an amazing breakdown of all different life insurance products, whole life, index universal life, all the way across the board. He breaks down each different company. He breaks down each different product that they do. It's really a phenomenal thing. The guy's one of the best minds in the industry. And so that's that. Now, what I want to do is I want to actually spend a little time talking very surface level, because I've got other videos. I've got an index universal life training playlist on this, but I want this video and the topic on this to be focused not on why I don't like IUL. I'm gonna talk about a couple things on that concern me with IUL, but I really just want you to be understanding all the moving parts inside of an index universal life. So there's a couple main topics that I think are on a very surface level that we need to cover, and I'll go into it deeper a little bit as we go. First and foremost, cap rates can be reduced, right? Now, I've talked about this. We've gone through the greatest bull run that we've ever seen in the stock market over the past 12, 13 years. In that period of time, we have seen cap rates go from upwards of 16 to 18%, depending on the company you're with, all the way down to 8 to 11%, right? So in the greatest bull market that we've ever seen, cap rates have come down. And so this is why I say, like, a lot of people over the last decade haven't been hurt by index universal life, but at the same time, no matter what, this all comes back to expectation management, right? So if just because their policy doesn't lapse, just because they aren't in a situation where they gotta run into their policy imploding, doesn't mean the policy is actually going to accomplish what their objectives were with that policy in the first place. Does that make sense? And so that's, to me, is the biggest thing. I never want to have to look at somebody in the eyes and take any strategy that I suggest to them to use and have to say I'm sorry for it because of the fact that it didn't meet the standard that I told them that it would meet. And so when you look over the past 13 years, cap rates have come down and down and down and down. And even though the policies aren't having a problem, they also haven't performed to the level that they were illustrated at because of the fact that the cap rates have come down. And that monster is going to rear its ugly head over the next decade if you believe that we are not going to have the next decade looking like we had the last decade looking, right? So first and foremost, cap rates can come down. Secondly, we have to look through the history, and I've got a great video on this that I did maybe 3-4 weeks ago on the last decade. Now, I always kind of talk about the 401k being a great failed financial experiment because we look back over the past 40 years, 401ks are younger than I am. They were created in the early 80s. And now we have the first generation that is actually gone to work, worked an entire career, leaned on the 401k as the main vehicle for retirement. And most people, 95% of people, are coming up short when it comes to their retirement. I call the 401k a failed financial experiment. The way I look at this is all of these strategies are failed financial experiments. They're not necessarily failed, but they're financial experiments that some of these, the IUL being one of them, the jury is still out on. We don't know what it's going to look like. But if you look at the UL, Universal Life, the original, which is what the IUL chassis is based off of, They failed horribly. They had a great decade and a half, and then they failed. And then they came out with VULs. VULs had a great run. And then in 2000, when the dot-com bubble happened, they had a complete colossal implosion. Now, IULs, this is important to understand because a lot of people say IULs have this history of success. Doug Andrew likes to tout the fact that these have been around since the early 80s. No, they have not. They have not been around since the 80s. IULs have been around since 1997. However, which is around when Roth IRAs were created, ironically, is when IULs were also created. The thing to understand is IULs didn't really gain traction until after 2009, right? Before 2009, there were like 4 companies selling IULs. Now there's nearly 50. After 2009, a lot of other companies got into the mix. Pacific Life became the #1 company in the world for IULs in the country in 2009. And when they did it, everybody else jumped on board. And it became this like snowball effect of all these companies jumping on the IUL bandwagon. And so that created this like illustration war. You know, it's important to understand that IULs have the story of upside potential and downside protection. Now, is that true? Do they have the upside potential? Yep, they do. Do they have the downside protection? To an extent, yes, they do. There is risk that comes along with IUL because of the fact that the shift of the risk from the insurance company onto the insured is real. I would say this is, if you really break it down, and I'm going to get into why I believe this, but I'm going to kind of tell you this right now. In a pure level, I think in Index Universal Life, and I say this because I've got a lot of actuarial science, and I've spoken to multiple actuaries and product designers and developers for these insurance companies that do this. And fundamentally speaking, IULs have about a 50 basis point upside on a whole life insurance contract with a similar company, right? And so it's important to understand that IULs were never designed to really outperform whole life insurance in a big way, not the way that they're currently being illustrated. And once again, this all comes back to expectation management, and is it being sold the way that it's actually designed to perform? And the answer is no. Now, when I say this, a lot of people go, well, Chris, we can illustrate it at this, and this is conservative. If we can illustrate it at that, this has got to be conservative. If the cap rate is 11% or 10% and we're able to illustrate it at 6%, the ups, the downs, all things being said, that's going to work out. But the bottom line is, it's not necessarily the case because there's a lot of other variables that go into it. There's reduction in cap rates, like has been happening since 2000. Well, I guess we'll just say 2009. We started this illustration war. I think it was around 2014 that regulation AG 49 was created. AG 49 was created because these insurance companies. I can remember when I was working with National Life back in the early, it was like 2011, 12, and 13 when this was happening. You could run these illustrations upwards of 9% per year, 9.5%, 10%, and you could pretty much put whatever number on it. And I remember being trained that if we reduced it to like 8.1%, that was considered being conservative. Now, if you go to National Life's products, the original Flex Life 1 cap rate is down under 7%. And, when we were originally selling it at 16.5%, running illustrations at over 8%. Well, guess what? National Life is now the #1 company in the world when it comes to IULs. And it's just, I don't know. To me, it's just crazy because it just goes to show that they've dropped these cap rates so significantly. Even the newer Flex Life products, the Flex Life 2, they started off at 14.5%. Now they're down around the 9 range. When those were getting illustrated at 8%, now the cap rate is just a little bit higher than what the original illustration rate was. So there's no way that product has any chance at outperforming the original illustration and expectations that people had when they bought that product. That is my challenge with it. So here's what I'll tell you is my belief is that if you can run an IUL with an assumed rate of 4.75 or so to maybe 5%, if you want to get really, out there, If you run it at 5%, just know that there's even then a little bit of risk. But if it performs the way that you want and you understand that, yeah, it's going to outperform a whole life policy a little bit as long as you fund it properly, which, by the way, you got to be really careful about that. I've run into so many policies that people have shared with me over the past couple weeks alone, from World Financial Group and PFA and PHP and all of those companies, every single one of them. I've seen multiple, especially in the past couple of days, just from World Financial Group, where the policy wasn't even funded to the target level. It's underfunding the target. It's just disgusting. And so once again, that's not a product problem. That's a person problem. That's a salesperson problem, right? That is the issue there. So I'm not saying that that's the product issue, but I am saying even if you design it properly, it's not going to meet the illustrative rates. So if you buy it, make sure your expectations are in alignment with reality. So what's happened then is they created AG49 to control these illustration rates. And now people go, well, they created this regulation to control the rates. But here's what happened. At that time, these companies got creative and they came out with all these ways to get around these illustrative rates. They created multipliers, they created proprietary funds, they created all the no cap rates products. They created all these different things and ways to be able to put more risk into the policy, to be able to make it a little bit more manipulative, to be able to bump the illustrative rates back up. Because listen, if you drop these down to where they should be, they're not going to sell as well. They're just not. And insurance companies, they need to make money. They need to sell this stuff, and they don't want to tick off their sales force because then they wouldn't be able to sell, right? And so understanding that, that we have this past decade where even in the biggest bull run, these policies have underperformed their original illustration rates, and the insurance companies are actually creating their own problem. And I want to talk about why really, really quickly, because here's the deal. When you look at this, let me draw this out a little bit for you. I'm going to try to extend my microphone over here a little bit. Hopefully that'll help. So when you look at this a little bit, let's see here. I'm going to turn that here so it's not glared. So when you look at the fact that let's say an index universal life company, what happens is, let's say you have $10,000 of cash value, right, in a policy. What they do is they say, well, we know that we can get you about 4% in the general fund. When they do 4% in the general fund, then they go, okay, we know that's going to create a $400 return, right? I'm going to call it $400 return. So with that $400 return, what they do, let me do this. Sorry about the glare. I don't know what's going on. I got all my lights here and it's glary. So with that $400 return, what they do is they go there and they buy an option with it. So they buy this option, right? And so when they go buy this option, this is important to understand, back in, say 2011, general funds were getting 6%, right? So they'd have a $600 budget, right? And options were cheaper, right? So this is the thing. This is why these policies are underperforming what's going on, right? So the policies are underperforming because they have a smaller budget. This 600 is now 400, right? And now the options have gotten more expensive. So you have less money to buy less options. And so therefore the cap rate goes down, because if you understand how this works, if the option wins, then you get the money. If the option loses, you lose the 400 and your $10,000 in your account is protected. That's where the upside potential and downside protection comes in. So even in this great booming market, cap rates have come down because of the dynamics that go into this. Now, this is why I'm really scared about index universal life over the next decade, because when we look at where we are right now with inflation going on, so I'm just gonna kind of go across this. And so if we look at the fact that with inflation going up, right, what's going to happen? Inflation has to be curtailed, right? We have to control inflation by raising interest rates. So I'm a big believer. If you look back through history, we have 1979 in 1979 and 1980 as an example. So back in 1979, Paul Volcker raised the federal funds rate from 6% to 19% almost overnight, right? And so imagine we're talking about raising the federal funds rate now 150 basis points over an 18-month period, and people are freaking out about what that's going to do to the economy. So my conversation with people is like, listen, if we have 8.5% inflation right now, if we don't raise the rates to 9%, 10%, they have to be higher than inflation to be able to curtail that inflation, to be able to slow down and cool down the economy. If we don't do that, well, inflation might get slowed down a little bit, but it's still going to keep going up and up and up. And what that's going to lead to, I believe, and is more of a deflationary depression. And when we have a deflationary, inflationary depression, not deflationary, but inflationary depression, what happens is we run into stagflation because the cost of everything is going to go up much faster than the incomes. So the amount of money people are going to have to spend in the economy for vacations, for stuff, for Christmas, for, putting money in the gas tank for your car and paying for your electric bill and all that stuff, that is going to catch up with you. And it's going to take money out of your pocket to do all the other stuff that's going to spur the economy. And so things will slow down. We're going to have a correction one way or the other. And when that happens, the stock market will struggle. So if you understand, we have this great 10-year cycle. We're not going to have another 10-year cycle like we just had where it seems so positive and so big. Now we have cap rates are now lower also. So even if we do the up years, it's just the policy doesn't get to perform because, like, let's think about it. If we had now a 9% cap rate, right, where we had a 16% cap rate at the beginning of 2010, right? Now 9%, that's a 7% difference. That's like 40% lower than it was back when we started the decade, right? So even if it doesn't get dropped that much right now, the fact of the matter is like that 9%, even if it only drops to 8% from 9%, the down years that we have are much more impactful in an IUL because of the fact that the cap rate's not going to be higher like it was before. And so therefore it's going to, it's not going to be able to catch up, right, as easily. Now, everybody that's talking about the fact that you have these no cap rate products and all that stuff, there is always a moving mechanism in no cap products that allow companies to shift the risk from the company to the insured, and they have the ability to blend in different cash blends into the indexing strategy that makes it so they can mitigate the risk and shift risk onto you and not get you the returns that you think you're going to get. That you just have to look deep into the contracts. Every company is different. I'm going to get Bobby Samuelson back on, and we're going to have a conversation about that because honestly, he's a wizard when it comes to talking about that stuff. And once again, go check out lifeproductreview.com. I think everybody should read that. If you're looking to buy or sell, at least spend $99 for a month because that's what the subscription is per month. And go do that. And I sound like I'm plugging in stuff and getting paid for it, but I don't even get paid. I have no affiliate code with him or anything like that. He's so good and so powerful with what he does. I think everybody should be involved and read his content because it's so valuable. So this is as interest rates go up. So let's talk about what I think is going to happen here. And this is why I say I think whole life insurance is going to perform better over the next 20 years than it is illustrated, and I think index universal life is going to perform worse. Now, granted, I'll be the first to admit that's my speculation, right? Like that's my opinion. There's no guarantee that that's going to be the case. I'll be the first to admit that. But when we use some common sense into why I think that, when the market goes up, if interest rates go up, what happens to the market? It comes down typically, right? And so think about this. If you have a 9% cap, right, and the market has, let's say 3 down years out of 10, right? That's a 27% loss, essentially. It's not a loss, but you're losing on 9%. Now, if let's just say you have 3 down years and you have let's call it 2 years at 5%, right? So now you lose another 8% because it's 4% off the 9 for each year. So it's 8%. So you have 27 plus 8 is 35, right? So you have 35% divided by 10 years for the decade. You're looking at 3.5% less. So you're looking at 9% cap, sure, but you're looking at really the upside minus 3.5 of 5.5% is what this is really going to do for you on an average. And then you back out the fees, you back out everything else. And if you back that out, you're looking at 4.5 to 5%. That's really where you wind up with this thing. And this is kind of, in my opinion, a good scenario, because like at the end of the day here, when we break this down and we say, okay, how is this going to work? If interest rates go up, what happens? The S&P is going to perform poorly, right? We've got this decade of stimulus where it overly performed, and so it's natural that the next 10 years isn't going to look like that. We gotta deal with kind of what we gotta correct the stimulus that got us here, right? We gotta fix the problem. And so when you look at that, that just is what it is. And so I think that's first and foremost. And then the facts are like, if oh man, I lost my train of thought. But as you're going through this, if you look at the fact that in those interest rate environment increases, oh yeah, this is where I'm going. It's going to create more volatility. Sorry, I lost my train of thought. It's going to create more volatility. And so what does volatility do? It's going to increase the cost of options. Now, we have more companies now that are in the index universal life space. They've created their own problem, in my opinion, because back in the early 2010s, IUL companies were buying millions of dollars worth of options, and now they're buying billions of dollars worth of options, and they're buying these blocks of options that are just so crazy expensive. And so the more it's a supply demand issue, they're driving the cost up. The IUL industry is driving their own cost up. This is one of the reasons they started building these proprietary indexes, and this is why they're so dangerous, is because of the fact that if you understand why they're doing it, then you understand that it's likely that they're not going to meet the results that they're after, right? Like they're just doing it to create artificial illustrative rates. It really is that simple. I probably could do a half-hour video on that, so I'm going to kind of go away from that. If you have any questions, make sure you comment on it, and I'll do videos on that specifically. I don't want to go down that rabbit hole. But here's what I'll say. When you look at the fact that we had AG 49 to control the illustration rates, AG 49 came out to like really rein in how people were illustrating the rates. And then what companies did is they created these multipliers and proprietary indexes and the no cap products and all that stuff. AG 49B is going to be coming out. And so if all this wasn't really concerning to you, I think AG 49B for people that sell this, and people give me a hard time all the time. They're like, oh, you're so hard line on this. I'm like, listen, I'm just patient because I know I'm right. And I know eventually people are going to come around because the regulators are going to get this right, and they're going to squash people, and they're going to squash people's ability to go out there and sell these in a way that they're not really truly understanding. And it's not most people's fault. I think most IUL agents have the best of intentions. I think they want to help people. Their hearts are in the right place, but I think the bottom line is they don't know what they don't know. And with that in mind, it's just one of those things. They know what they've been taught, and they focus on the good stuff about it, and that's what they sell. And I guess I can't necessarily blame them for that because most people don't have access to the right information, but that's why I'm so passionate about pitching Bobby Samuelson's blog, Life Product Review, because it's so powerful. Now, here's my belief is that life insurance should never be an investment. It should be a storage vehicle for your capital. So when I talk about the fact that I love whole life insurance and I go with whole life insurance over IUL every single time, it's because of the fact that I believe that your number one investment should be in yourself, in your business, in real estate, and stuff of that nature. And if that's the case, and you believe that, well, then whole life insurance is a great storage vehicle for your capital. It's going to be a great long-term hedged savings account. Notice I'm never going to say whole life insurance is a great investment. It's a crappy investment. It's just not an investment at all, quite frankly. Whole life insurance is a great savings alternative if you need an emergency fund, if you need an opportunity fund, if you want to invest in real estate and have a capital reserve, if you're a contractor and you, instead of keeping your $500,000 for your projects in a bank account, have a whole life policy. Instead of putting your money in other accounts, like we're in a CD or bonds where maybe you'll get a little bit of better return, but you lose liquidity, put it in a whole life policy. Long term, it's a great safe haven for your capital. That's going to be, once again, the preservation of capital is the number one focus of life insurance companies. Think about it this way. This is. Let's use a little common sense here for a second. I'm gonna erase this real quick. If we use a little common sense, right, and think about this, in a world where life insurance companies, where's my eraser here, or my marker? In a world where insurance companies are getting 4%, right? Insurance companies getting 4%. In an IUL, they're saying that you can get 6%. So 6%, this is what the salesperson people are. I encourage, as a salesperson, I encourage you to think about this and really dive deep on it and stop just selling because somebody told you it works a way that you're being told it works, because I promise you it doesn't. If you're looking to buy it, you buy this for yourself, I encourage you to really think and use some common sense on this. If the insurance company is getting 4% in their general fund, which I guarantee is what it's doing right now, between 4 and 4.25 right now, that's the best any of these insurance companies are doing. If that's what they're getting, and they're telling you that these companies know how to get you 6% long-term conservatively, and this is a conservative number, right? Because we use the index and we're buying these options and we're doing this, we're doing that. If you understand how these insurance companies are buying the options, they're not taking a lot of risk because they don't have any risk to take. Options from a purist perspective are simply used to hedge. They're leveraged and utilized. It's a financial tool designed to be leveraged as a hedge to get closer to a zero return and to balance out risk. Think about that, right? So how insurance companies do this, if they could get you this 6% with the options and everything that I just explained about the cost of options and everything that's going on, why wouldn't they just say, oh my gosh, we're not going to do that. We're going to go get ourselves 6%. And by the way, since we don't have insurance fees or anything like that, we can get 7%, right? So you know what I'm saying? Like, the reason is it doesn't work that way. It just doesn't work that way. Yet everybody's out there selling it that this is some magic golden goose. It's going to be able to, create these magical results that the insurance company can't even produce for themselves. So how are they going to be able to produce it for you? Like, if we use common sense, it goes a long ways, right? And so that's something that I really, really want to encourage people to think about. Here's the deal. At the end of the day, IULs are not a bad product. Once again, they're sold improperly. If you look at an IUL and you can run it at 4.5 to 5%, and you are comfortable with that, and you understand that you still have a little bit of risk associated with it, and you make sure that it is maximum funded and massively efficient, and you work with an agent that knows how to do it. And I don't care what anybody says. I encourage you, if you are in any of these MLM companies that are doing it, I'm not saying you're doing it wrong, by the way, but what I will say is 99 out of 100 agents that I've seen in these companies are doing it wrong. And I have seen some that do it right as far as that goes. And those who do it right, I still think there's more risk than you want to acknowledge. Now, the reason that I believe whole life is better isn't because IUL is horrible. It's because of the fact that I believe from a long-term perspective, life insurance companies are not designed to be investment companies. You're like all the people out there selling tax-free retirement. The idea of doing that. Now it works. It's like there's elements of IUL that will work. It will get you tax-free income. It won't get you the amount of income that they're going to illustrate for you. It's going to have more risks associated with it, because when you go and you get if you have, let's just say you have $500,000 in once you hit retirement in your IUL, and you start pulling out $50,000 per year in income, right? So you use an index loan for that because that's what they do. So they tell you you're going to take a 4% index loan, right? And then we have, and then what happens is you have to pay that 4%, but you don't have to pay it back, right? Like, so the idea is you're going to have positive arbitrage, right? You're going to be earning 6%. So you're going to, these things will illustrate. This is the sick thing. This is the other thing that AG 49B is going to correct, I think, I hope, God willing. And I've heard rumors that this is the case, but they're going to get rid of the 50 basis points of positive arbitrage. When you illustrate these, it allows you to illustrate a positive arbitrage between the index loan and what you're earning. So if you pay 4%, it's going to illustrate at 4.5% positive every single year in retirement. Now, that's just not realistic. That's not going to work that way. And so when you break it down, if you have a couple negative years and you've built up, let's say you're 4 years in, you got like 200,000 of loans, right? And then you have a negative year. Not only in that negative year do you pick up, $16,000 or no, not 16,000, $8,000 in extra loan expenses, interest expense, right? Because that 4% on 200,000, that money's due no matter what. And if you don't have the positive arbitrage, this goes up against your fee. You have to pay that money. And by the way, if your cap rate has come down to 8%, that's going to be impossible to make up for in retirement when you start chasing a couple negative years in retirement. That's going to be really, really hard to make up for. Trust me, I've seen it. It's not good. And so you have to take that into consideration. But the bottom line is, you're not going to have this 50 basis points with the AG 49B. As soon as you're not able to illustrate this whole conversation about tax-free retirement is going out the window. Now, can an IUL be utilized if you have it funded properly and if you have enough money there properly? Can it be utilized as a volatility buffer? Meaning, if you have your assets sitting, in an account, and when I say assets, you have actual, good, I don't know, I don't want to say good in the context of a qualified plan, but let's just say you have a Roth IRA or something of that nature. You have a Roth IRA, and maybe the market goes down, right? The worst thing that you could do is liquidate a performing asset and try to take income out of a negatively performing asset. So if you have an IUL over on the side and it's sitting over here and it only lost a little bit because of the fees and like whatever in the insurance policy, so it makes more sense to take money out of the IUL during negative years, right? And then let the market come back. And as it comes back, you can maybe pay back the loan a little bit if you need to at that point in time. You can manage your IUL cash flow a little bit more. But the biggest challenge is these are not set it and forget it products. You cannot just let it go. And what I know is most people, unfortunately, in this industry, come and go. They're not going to be here 30 years from now or 20 years from now or whatever when you need to utilize this product for income and retirement. And I promise you, you're not going to understand it enough to be able to manage it on your own. So yes, I know there are some people that can work with you and help you manage it and so on and so forth. Make sure the expectations are there. Make sure everything is really, really optimized, designed properly, and make sure your expectations are in alignment with reality, because unfortunately right now at this point in time, you can't even illustrate them at the levels that I want to illustrate them with. So, or that you should be able to illustrate them with to actually have a realistic expectation. So if you look at, I don't even need to write this. If you look at an illustration, you're going to notice typically there's 3 or more columns. You have a guaranteed column, which, by the way, in an IUL and whole life insurance is the same bodes for both. The guaranteed column is kind of a joke. And you're never going to have to rely on the guaranteed column. That's assuming the worst case scenario every single year from here till eternity, and you're never going to run into that situation. So you don't have to worry about that. The middle column in an IUL is more in the area that I would focus on being reality. I would look at the right column, the far column, which is more of the current assumption column, and I would not even, I have zero faith, that your illustration or that your money, your account will actually perform according to that that column at all. And so, you know what? That's it. I mean, it's not that these are bad, but I will say this. If you are a real estate investor, if you are an entrepreneur, the best investment that you can make is in yourself. I believe if you can't get a better return in your business than you can get in an IUL, in the stock market, in an investment, you shouldn't be doing your business. Like that's just my belief. I'm a big believer that if you can't get a better return in real estate, granted, everybody's got their own slant as to why they believe what they believe. The reason I love whole life insurance and the reason I beat this drum so hard is because I believe that, once again, I'm going to go back to this conversation. I believe that all the 401k, the Roth IRA, the UL, the VUL, the IUL, all of these have been experiments, financial experiments to figure out what to do, and they're all systematically failing so far. IUL, the verdict is out. I get it, but we're still only about 12 years into this, and so I don't want to be caught holding the bag, so I'm going to stay away from it. Now, could I be wrong? Maybe, but history is showing me that I'm probably not, right? So if that's the case, I'm going to look back and I'm going to say, okay, what are two assets that I can combine when you look at them together that have over 100 years of history of success? And that's real estate and whole life insurance. Those are the two most stable long-term financial assets that got inflation hedges that are going to grow. They're going to manage risk. They're going to preserve your capital, and they're going to provide opportunity, tax benefits, cash flow, all these different things that you need to be able to be successful with your money. And for me, I'd rather take a time-tested strategy that I know works and is going to be there, and it's not an experiment. That's why I believe what I believe. And at the end of the day, that's just me. That's why I love doing what I do. I work with a lot of entrepreneurs. It's not for everybody. Now, on the other side of the pendulum, if you're a W-2 employee and you have no aspirations of creating anything, of investing in real estate, of building your own business, of actually going out and creating something more significant in your life, which no judgment assigned to that statement, by the way. Like, God bless everybody that has the tolerance to go to work, and we need people who can go out and be nurses and be teachers and be all these things. It's what makes the world go round. So if that's you, then it takes a different strategy, right? Like maybe just going to work and saving and holding and whatever, buying and holding would work for you. But I'm a big believer, even if that's you, if you want to go out and create more, you can do side hustles. You can invest in yourself and put money aside and get into real estate and do all these other things. That's just me. If that's not you and you don't have that risk tolerance, if you don't have that drive, if you don't want to put the grind in to be able to be that successful, I would say I still would caution you from, because of IUL, unless you're working with a really, really, really sophisticated person when it comes to helping you manage it, and somebody that you really, really trust, somebody that's got at least a decade of experience in this business. I would be really, really, really careful about getting involved with that situation, right? What I will say, though, is if you need an emergency fund, if you need an opportunity fund, if you are somebody that wants to hustle, if you are somebody that wants to go create in something, you know what I want to do? I'm sorry. Before I go, I'm going to do one thing. I want to show you why I think this is so important, because I want to break it down into its simplest terms. And so here, I'm going to do this. I'm going to just show my screen for a second, and I'm going to end with this. This is an illustration that I had ran for somebody. And you can see here, this is somebody that had $30,000 in their savings account right here. And they want to save $1,000 a month because that's how much they want to save. And the reason that they want to save is not to invest in this policy. This is not the investment. This is not what they're looking to save for some tax-free retirement. They want to save to be able to buy their first property. They have $30,000 and they have $12,000 a year that they can save. Well, the idea here is they're married, they have kids, right? They had $30,000 and they got this $12,000. Year one, out of the $42,000 that they saved, they have $38,500 liquid. Year one. By the time year two comes around, they're putting in $12,000. Their account is growing by almost $12,000, $11,922. By year three, they're putting in $12,000. It's growing by $12,499. By year four, it's growing by $13,110. And you can see it gets better and better and better. At year 10, they've put in 120,000 plus 30, 150,000, and they got $169,000, right? Now, that may not seem like a lot, right? Like from an investment perspective, that would be a horrible investment. I'm the first one to admit that. But we used a term rider, so you can see the term rider here drops off. About $600,000 of death benefit drops off. But we did that because I just wanted to show this as reduced paid up, meaning you never have to put another dime. And this is all going to be happening from that point forward. You never put another dime in, and it's going to keep growing. This becomes an inflation hedged savings account on steroids. And once again, if the interest rates keep going up right now, this policy I could confidently say is going to outperform what I'm actually showing you right now. And I could say that with a lot of confidence. And so when you take that into consideration, this is why I love this. So now what's happening here, I can show these people within 3 years, they're going to be able to go out, probably actually year 2, they're going to be able to go out and they're going to be able to get their first real estate investment. They're going to be able to borrow against this or assign a cash value line of credit to this, which operates very similarly to a home equity line of credit. And they're going to be able to borrow against it. They're going to be able to leverage this money. They're going to be able to put that money to work inside of real estate. They're going to be able to take the cash flow from the real estate, pay this loan back. As they pay it back, their money becomes reliquefied, so they can take it and put it towards opportunity, all in another area. And if this money is going to be growing, let's just see the annual dividend is 1820 on 50,000. So even year 2, it's growing at 3.6%. That and it gets better and better and better as it goes. Even in year 2, you can get a cash value line of credit for between 3 and 3.5%. So you have positive arbitrage on the money that you have, guaranteed, baked in. You can only do that in a whole life policy. You can't do that in an index universal life. In fact, if you think that you're smarter than a bank, my encouragement to you would be go to a bank and ask them if they'll give you a line of credit associated with your index universal life policy, and they're going to tell you no, because banks know the risks that go along with those, and they won't do it. So really important to understand. But listen, guys, that's all I got for today. I mean, I hope you found value in this. If you haven't already, comment in the comment section below when we're done. I hope you found value. I really do. Like and I hope this comes across and really starts to show the fact that I am not a hater of IULs. I'm just a hater of the way that IULs are sold. And now I have my 3-year-old daughter at my door. Hold on one second. What? Come here. Say hi, everybody. All right. So now I got my daughter here. So say hi to everybody. No, you don't want to say hi? All right. So I guess I got to go because it's time to go hang out with the family. But guys, I hope you found value in this. If you haven't already, make sure you subscribe. Hit the bell. That way you're notified. Hi.
Can I have an apple?
Sure. Go ahead. All right. Love you. I'll be right out. Okay, thanks, babe. So this is the joy of having a studio at home. So make sure you subscribe, hit the bell, and as always, I hope you have a blessed, inspirational day, and I'll see you tomorrow on the next video.